Welcome to the APW Partners Quarterly Market Update to 30 September 2023. And joining me again today is our investment consultant to our investment committee, Dr. Steve Garth. Welcome, Steve.
Yeah, thank you, Dermot. It's great to be here.
And so another interesting quarter, Steve. When we look at the key themes that really shaped financial markets for the quarter, we saw some of those big US tech companies that we spoke about, the Magnificent Seven, not performing so magnificently in the next quarter. And that was largely driven by the central banks around the world talking about and indicating that interest rates would have to be higher for longer. And so that higher for longer narrative really shook particularly equity and bond markets over the quarter. And coupled with that was complicating the landscape around higher oil prices that really surged just in the last few weeks and mounting concerns around the Chinese economy. So there's an array of factors that are really shaping markets at the moment. But despite that, we learn about this time and time again that what happens in the global economy doesn't always intuitively translate to the outcomes for capital markets, do they? So against that backdrop, how did the Australian equity market fare over the quarter?
Yes, Dermot. Well, starting with Australia, but we're going to find a similar theme throughout markets around the world. And that's that when you look at the 12-month return, in other words, from the end of September last year to September the 30th just now, returns are really good. In Australia, the ASX is up 13.5%. And markets tended to keep going up throughout the year, despite the interest rate rises. But as you were saying, it all came a little bit unstuck only 2 weeks ago when Jay Powell, the federal chairman of the Reserve, really came out and said, guys, we're going to keep these interest rates higher for longer. And it did spook the markets. They were expecting that we were at terminal rate and now rates would start coming down and it would be happy days. And so in the last 2 weeks, you see the Australian market come off. And so for the quarter, it's a very small negative return. Still a good 12-month return, but a small negative return in the quarter.
And so looking at developed markets, obviously that was a key theme of the last quarter where we saw the US tech sector really coming down to 7 names driving the predominant outcome in terms of the positive return. So how did developed markets fare given that they came off those highs?
Yeah, well, very similarly, but you will see here the 12-month return is sensational, 21.5, and that's really due to what you're saying. The developed market, 65% of that is in the US, and of course the US market really has been driven by those Magnificent Seven. But it won't surprise anyone to know that when we talked about the market wobbles only a few weeks ago, guess who got hurt the hardest? It was the tech stocks, and they're actually in what they call correction territory. They're down 10% from their July highs. But nonetheless, it's a 21.5% return over 12 months for developed markets, and just like Australia, a small negative return in the quarter.
So a temporary stumbling block for the quarter, but still pretty strong numbers for the 12 months.
For the 12 months, it's hard to beat those kind of numbers.
Yeah, they're pretty good. And so when we look towards emerging markets, obviously there's a lot of news, particularly over the last month, as to what's happening in China. We've seen youth unemployment skyrocket towards 30%. We've seen their property market being quite shaky there because it's so debt-fueled. And some of the data coming out of China is a bit concerning, particularly on the demographic front. So what's happening in China, and obviously it makes up about a third of emerging markets. How have emerging markets fared in that environment?
Yeah, because the Chinese economy is so stagnant, and it's actually a huge shock. When you go back to the start of the year, all the commentators were saying China is going to drive the global economy because they're out of the COVID lockdowns and it's going to be a really boom time and it's going to help every other economy. In fact, almost the opposite has happened, is the Chinese economy just hasn't got going for the reasons that you mentioned. And in fact, they're going to be a drag on global growth next year. So as you'd expect, if China's not doing so well, and it is, you said, Dermot, over 30% of the emerging markets, then the general emerging market exposure is down. But it's still pretty good. It's 11.5% over the 12 months. Not a dissimilar figure to Australia. And it's just a slight positive for the quarter. So again, we're seeing the same thing. Good returns 12 months in global markets and very flat in the quarter, all due really to the last 2 weeks.
Interesting. And when we look towards bond markets, obviously there's a couple of key questions that are running through bond markets at the moment in terms of those yield curves that we spoke about last time. And those chief questions are we there yet in terms of the interest rate hiking cycle? And if we are, then what happens, I guess, in this forward period in terms of where interest rates go from here? How much higher do they stay for longer? And so what are bond markets telling us about those messages at the moment?
So the bond market is telling us that we're not there
Not
yet.
there,
We're
not
close,
quite.
but we're not there.
Yeah.
So it's been an interesting period because both in the US and Australia, interest rates have been on pause over this quarter. But you can see on the chart I'm putting up here that the bond yields have kept going up. And of course, when bond yields go up, bond prices go down. You can see that in the underlying column, which is a quarter by quarter of the global bond index. So it was a little bit negative last quarter, and it's a lot more negative, down by 2.4% this quarter. So the bond market is signaling very strongly that, yes, we're probably close to what they call the terminal rate, but there's one or maybe two more rate rises to go. The bond market is also signaling, because the long end of the yield curve is coming up a little bit, that, to paraphrase Jerome Powell's words, you can expect these interest rates to stay higher for longer. We should point out, though, Dermot, for those who have bonds in their portfolio, must be thinking, gee, it's been a bit of a rough trot.
Yeah.
You will notice that the 12-month numbers are positive. So in other words, bonds are now yielding 5% or so. So that's the income that you're getting out of your bond. And that's offsetting the fact that it's a little bit negative. So while they're not fantastic returns, certainly bonds are in a good position.
Yeah, and the longer that we see that higher income coming through, that should offset the capital loss in terms of the prices having fallen over the last 18 months or so, to offset that with the higher income coming through.
Exactly right. And of course, bonds are now also really well placed to be that defensive asset that we kind of hope and expect them to be. So if the equity markets do topple over, and again, we don't know what's going to happen, but the bonds are certainly there now as that support mechanism behind that.
Very good. Well, thanks, Steve, for sharing those insights. And just to round out the presentation for today, we wanted just to cover off on a couple of the key aspects of our investment philosophy. And one of the key aspects of that investment philosophy is to focus on and understand the importance of capital growth that can be achieved by diversifying really broadly across securities, asset classes, and global markets, and focusing on what we can control. There's obviously a lot of things we've spoken about today that we can't control, but that's where that evidence-based approach to giving us a framework for making investment decisions is really going to hold us in good stead when it comes to these uncertain capital markets that are just par for the course when it comes to investing. And ultimately, that gives us, our clients, the greatest probability of achieving what's important to them. So I think that concludes today's presentation. Thank you for sharing your insights today, Steve.
Yeah, thanks, Dermot.
We look forward to seeing you all again next quarter.